So welcome back. This is lecture 2, which will be the last lecture also of study note 1, which is Introduction to Cost Accounting. Okay, this is for paper 8 cost accounting of CMA intermediate, and attempt is June 2022 attempt. Okay, right. So now we will continue. So this will be our last lecture, as I said, for this chapter. This chapter has lots of theory questions. Okay, theory concepts, lots of them are there. Okay, so it is important from a theory point of view. Okay, so right, so let's continue from here. The next thing is responsibility center. Okay, responsibility center is what? Okay, it is any part of the organization, any cost center, you can say, or cost center, which is headed by a human being. Okay, that is called as responsibility center. The responsibility center is very close to cost center in terms of its meaning. Okay, a segment of business organization whose responsibility is assigned to a specific person. Okay, so factory may be split into many centers or cost centers, and a supervisor can be given the responsibility of each of them. So responsibility center is nothing but a cost center. Okay, so cost centers can be personal or impersonal. Okay, personal or impersonal. Right, personal means, okay, which will have some person, some people in it. Okay, and if the cost center is headed by a person, then he will become responsible for it. Okay, so only those cost centers which are headed by a person will become responsibility centers. Okay, so now it doesn't mean that cost centers who have someone heading it, a person heading it, will become responsibility centers. Okay, for example, cost center wise, you might have 4 cost centers. Okay, 3, 4 cost centers. Okay, for responsibility center, you might want to split one cost center into further two parts, and here there will be one supervisor, and here there will be another supervisor. Okay, that is possible. It's not essential that only those cost centers which have a person heading it will become a responsibility center. Responsibility center is a different concept. Okay, so which is why, so this is responsible, that's how responsibility center comes into being. Okay, and impersonal cost centers are that they cannot become responsibility centers. Okay, so just to remember in short, what you can say is responsibility center, okay, is kind of a cost center which is headed by a human being. Okay, right, so then all costs relating to it are collected and manager is judged by, okay, the performance of that responsibility center. Okay, so even an individual machine can be a responsibility center for cost control or cost reduction. That means responsibility center is just something for which you are collecting the costs and seeing the performance of the head of that either department or even a machine. Okay, or any part of the organization. Okay, that will be your responsibility center. Okay, so this is basically responsibility center concept is only for cost control, because only those people can be made responsible who are human beings. Okay, right. Next is profit or investment center. Okay, so what have we talked about so far? We have talked about cost center. Okay, then we have talked about responsibility center. Okay, right, and now we are talking about profit center. So profit center and cost center are closely related concepts. Okay, responsibility center is used separately in certain countries. Okay, but cost center and profit center are very close concepts. Cost center will be such a department, okay, or a part of a department, okay, for which you want to collect costs. You want to collect costs, okay, for a particular department or a particular area, that will be called as cost centers. Now, profit center is something, okay, if you are collecting cost also, and this center is producing some distinct product also, okay, so you can collect revenue also, okay. So that means profit center is like a department, you can say, okay, department of the organization. Fine, it is like a department, right, where you will collect, you will be able to collect cost also, and it will be producing some goods of itself, and it can sell it separately, okay. So you can collect both cost and revenue. So that means if you have cost and revenue, you can determine its profit also, okay. So it is like a, you can just say it is a small independent part of the organization, okay, which functions independently. That is called as profit center. So profit center will also be collecting cost. Cost center will also be collecting cost. But cost center will not be collecting revenue because it will not be selling independently. Okay. So that is your profit center. And these profit centers are sometimes called as investment centers. When they are called as investment center is, okay. So if there is a, say, profit center, okay, here you know that you can collect part of, say, you will also know the investment in the profit center, okay, what investment you have made in the profit center. For example, the investment you have made is 1 lakhs, let us, okay, 1 lakh is the investment you have made. You know that, okay, you know that you can get return on capital, let us say, of 10%, okay. You know that you can get a return on capital of 10%. So what will be the return on capital on 1 lakh? It will be 10,000. Okay. Okay. So what you see is, you don't you will not compare this cost and revenue here. What you will tell him is, in place of its cost, you will just put this 10,000, which is the minimum revenue it should get. Okay. And you will compare how well it is doing, okay, compared to this 10,000, okay, which is the minimum which you would have got had you put this 1 lakh in a bank, okay. So if you are comparing it this way, then the same profit center, okay, it will be called as investment center, okay, because you are comparing with relation to investment. So it will be called as investment center. Fine. So that is investment center. That is the concept of profit and investment center. Okay. Then next is cost unit. So we talked about cost center and cost unit, correct? The other previous day. Okay. So cost center is what we just discussed. Okay. Cost center is basically, and you can say some big part of the organization for which you are collecting costs. Okay. That is your cost center. Okay. So when you collect cost, the largest part for which you will be collecting cost is called cost center. The smallest part for which you will attempt to collect cost, smallest part, okay, will be called as what? It will be called as cost unit. Okay. The smallest part will be called as cost unit. So this is what I had given you example of 1,000 bricks. So price of bricks is quoted in thousands. Okay. So, so cost collection will be attempted for 1,000 bricks. Company will not attempt collection for 10 bricks. Okay, it will be 1,000 bricks is the minimum lot for which they will attempt it. So this depends on the way the products are marketed. Okay, it depends on that, right? So it can be different for different companies also, but normally it is same for one market. So brick market, whichever company is producing bricks, its cost will be reported in per 1,000 bricks. Okay, so this is called as cost unit. Fine. So unit of product or service in relation to it, cost are ascertained. Okay, it's the narrowest possible level of cost object. Okay. So it is a unit of quantity of product, service, or time in relation to which cost may be ascertained. So in bricks, what we saw is quantity of product. Okay. Similarly, you can do it for service also. So here are some examples. Service cost per ton of steel. In steel industry, they collect cost for 1 ton. Okay. You collect cost for 1 ton of steel. Okay. And in transport, you collect cost for per ton kilometer. So in transport industry, okay, where goods are transported, what you do is you find out cost of moving 1 ton. Okay, 1 ton of material for 1 kilometer. That is the minimum for which cost collection is done. Okay. So it depends on industries, whichever industries we are talking about. Fine. Okay. So these things you will understand more as and now we go ahead, because we will be talking about when we go to methods of costing. Okay. When we go to methods of costing, that time you will understand everything. So in service costing, what are the what is the cost unit which is used? What are the different cost units which are used, and all that you will understand as and now we go ahead. Okay. Just understand that for different industries, it is like in different way they report cost. For example, clothes industry. Okay, you would have gone to buy clothes, right? If you traditionally, if you go to buy clothes to stitch them, earlier we used to stitch them. Even now, many people like to stitch clothes. Okay, so they what do they do? They just buy clothes, and then they give it to a tailor to be stitched. So when you would have gone to buy clothes at some point of time or the other, so there you can see that clothes are stored in big rolls like this. When you ask for a cloth, the shopkeeper will take out a roll, and then he will take it out, and from there he will cut some meters and give you. Okay, again, cost collection for that is again done per roll like this. In Hindi, they call it than. Okay, how many thans you want, that's how they measure it. So this is all, as I said, it is industry specific. So in our local places, it is measured like this. In some other country, the unit would be something else. Okay, that's why cost unit is based on the market in which you operate. But for one market, it is the same. Okay, so now sometimes one job or one batch can be a cost unit. So cost unit it's not essential that it has to be uh, a very low level where you are measuring it at a very low level. Okay, it can be one batch also, one job also. Okay, it can be big also. If, for example, now if you are manufacturing nuclear reactors, okay, nuclear reactors. So one reactor, for manufacturing it, it takes about 5 years to 10 years. Okay, at least 5 years, let us say. Okay. So here, what will be the cost unit if you've taken the contract of one reactor? Okay, the cost unit will be one reactor only, correct? You cannot show it as half reactor or anything like that. So in this case, your cost center will also be one nuclear reactor. Cost unit will also be one nuclear reactor. So as I said, cost unit depends on the market, the way goods are bought and sold in the market. Okay, fine. So let's see some examples of cost units. Okay, so these are some examples of cost units. Okay, now automobile, number of vehicles. Okay, it is collected. So actually, these automobiles, they are manufactured in batches. Each batch has say 50, 100 like that. So per batch is the minimum, will be the minimum cost unit for which you will collect the costs. So hence it is number of vehicles, so which actually is a batch. Okay. So cable. Okay. So cost unit for cable, if you are selling cables, it will be in meters or kilometers. Cement will be ton. Chemicals and fertilizers will be liter, kilogram or ton. Okay. So this is the cost unit which is used. So if you ask for a quotation, the manufacturer will give you quotation either for 1 kilogram, 1 ton or 1 liter. So big manufacturers, they might give you for 1 ton. They will not probably sell below a ton. They will not give you in kilograms. Smaller shopkeepers can give you in kilograms. Okay. Fine. For gas, it is cubic meter. Okay. And electricity, kilowatt hour. Transport, ton kilometer means cost of carrying 1 ton for 1 kilometer. Passenger kilometer, cost of carrying 1 passenger for 1 kilometer. This is how they give the costs. Okay. So then hospital, patient a day, 1 patient for 1 day. Okay. So it can also be if say it is a room with more than 1 beds, then it will also be bed a day. Okay. Cost of 1 bed, 1, right? Hotel per night. You all would be knowing, like somewhere or the other we go for picnics and all that. You would have stayed in hotels. You know that they quote per night. Okay. Per bed, per night. Right. And then education, 1 student year. Okay. Telecom, number of calls. Okay. They quote in number of calls. It is basically, if you see the plans and all, okay, whatever telecom companies have, mobile companies, okay, they would give you like for 200 calls, this is the cost. For 400 calls and this much data, this is the cost, like that, right? So it's based on number of calls. BPO service, accounts handled. Cost unit is for accounts handled. That is, the BPO units, they give service to other organizations. Okay. So accounts means the organizations to whom they are giving service. If 10 organizations they are giving service, then it will be cost unit will be per account handle. That is per company for which you are giving service. Here again, your cost center and cost unit will be the same. Okay. Then professional service, chargeable hours. Okay. Any service, professional service you are taking, they'll tell you for these many hours. It is like that. Actually, in some, if you take car for hire, okay, car or something for hire, they will quote you passenger kilometer, plus they will also say for these many hours there is a fixed charge. Okay. Now these, no, these are asked in objective questions. Every time at least one is asked. Okay, so you should know this. Okay, well, how they will give it straight away, like just give the cost unit of hospital, something like that. Okay. Fine. Right. So then next, what we'll talk about is cost allocation. So next time, next Monday, we will start marginal costing. Okay. Next Monday, we're going to start marginal costing. Now, next part here is cost allocation. Okay, this might be a bit boring, this chapter, but we have to go through it in detail. Okay, because you need to know these concepts. Because as and now we go to future chapters, these will be enlarged. These concepts will be enlarged. Okay, more number of times you hear, more you will be comfortable with it. Fine. Now, cost allocation. This says when items of cost are identifiable directly with some products or department, okay, they are charged to such cost centers. This is called as allocation. Okay, for example, okay, yeah, now wages paid to workers of service department can be allocated to particular department. Okay, indirect materials used by particular department can also be allocated to that department. So here in cost allocation, only thing which is seen is, say I have different departments or cost centers. Okay, let me say these are different departments or cost centers. Okay, now here, if I have incurred an expense, if I have incurred an expense here, okay, and I can relate it directly to this. Okay, so basically there are, say, 5 employees that I have hired. All 5 have worked for this cost center or department. Okay, so I can directly identify it. That process is called as allocation. Okay, now same way, if I have hired 5 employees, okay, and they are working for all of these, okay, and there is no direct basis, that it's not that 2 of them are working only for this, one is working for this. It's not like that. Okay, it is just as per requirement. Sometimes 2 people say work here for 2 days, then for 2 days they work here, and there are others who are working here, like that. There is no direct pattern that which employee will be working here. So in that case, I cannot apportion the salary of 2 employees to this cost center or department, correct? Because he has not worked there fully. I just have to pick some basis. What I will do is, for all 5, I will add up their salary. Okay, I will add their total salaries. Okay, and then I will just see the total number of service requests. Say if they're going and attending based on some service requests. Okay, service requests I'm seeing in this department, I have 20 requests. Here I have 40 requests, and say here I have 50 requests. Okay, so based on these service requests, I will allocate the total salaries. Okay, so it is not a direct basis. I'm using something, and out of that I'm deriving, and then I am splitting the amounts. Okay, that is called as apportionment, right? So you can have 2 ways of distribution of cost. So one can be allocation, which we saw here, right? And second is apportionment, which I just showed you. Here, first of all, allocation calls for 2 basic factors for allocation. What are the qualities needed for which you will allocate costs? Okay, concerned department product should have cost the cost to be incurred. So that department needed those employees directly. Okay, it must have caused the cost to be incurred, and exact amount of cost should be computed. Okay, so it should be a very direct relation. Only then you can allocate cost. Same thing in apportionment. Okay, when items of cost cannot be charged directly or accurately identified, like the example which I gave, you prorate them. Prorate means you distribute it on some basis. Okay, on some predetermined basis. This is called as apportionment. Okay, so here predetermination of suitable basis of apportionment is very important. Okay, so you have to determine it in advance, which is very important. Because why it is important? Otherwise you will not be able to split your costs into various products or departments which have used them. Okay, so principles which are adopted for apportionment are these. Okay, principles for apportionment are basically 3 principles. One is service or use, second is survey method, third is ability to bear. Okay, so we will see these things, how we can use these things in your chapter called overhead. Okay, so in overhead, basically the overheads more often than not are apportioned. They have to be apportioned. So which is why, okay, we will require uh, the principles for apportionment of overhead. So which are these actually? Okay, I'll just tell you in short what these are, so you just get an idea. Okay, service or use is how much one unit is using. The example which I gave you, that was on service or use basis. Okay, right? So basically you based it on service requests. Okay, so how much they are using, based on that you apportion it. So that is called service or use. Okay, that example. A survey method is, this is more of a qualitative method. Okay, so this is used, say if the same amount of things have been used, cost have been used to prepare two types of products. One is higher quality, one is lower quality. So what you do is you try to give more cost to the higher quality, because its revenue also will be higher. Okay, so higher quality things are given higher share of cost. That is survey method. Okay. Now ability to bear is, again, see, sometimes what happens, you have 5 cost centers, 1, 2, 3, 4, 5. Okay, so this is a very small cost center, and by, if you are distributing it properly, say the cost comes to 100. Okay, okay, and this cost center itself is very, very small. Okay, it is, let's say, so far worth only 20. Okay, so what you will do is, and these are all bigger, larger cost centers. Okay, so you will not give it 100 share. Okay, so even if 100 is equal share, ideally you would have given equal, but because this cost center cannot bear that much cost. Okay, so which is why in this case what you will do is, some cost center which has got a higher share of the cost. Okay, so more important cost center will just give some part of it back. Okay, so this is called as ability to bear. So these are the 3 ways you can apportion, okay, amount, right? So basis ultimately adopted should ensure an equitable share of common expenses. Okay, common expenses must be distributed properly, equitably. Okay, for the cost centers, and the basis once adopted should be reviewed at periodic intervals. Okay, now basis go on changing. So if you're adopting one basis today, it doesn't mean that you should go on with it till the end. Okay, so every year, or maybe after some periods, you should see whether the apportionment is being done properly or not. Okay, so that is what is, these 2 things are your main thing. One is your cost apportionment and cost allocation. Okay, allocation and apportionment, both are methods for distribution of cost. Okay, from one cost center to some other cost centers. Okay, right? And then comes absorption. Okay, now absorption is something, okay, I'll tell you what is cost absorption. Now say your total overheads, okay, let's say your total overheads are 1 lakh. Okay, so your total overheads are 1 lakh. This is the beginning of the year. Let's say 1st January. Okay, January to December is our year. Fine. So 1 lakh is the total cost. Now, okay, this is the total overhead for this year. Okay, whole year. So because it is not yet the end of the year, we are still at the beginning of the year. So I cannot tell with confidence that overheads will be 1 lakh. Okay, it can be little more, little less. Okay, so this is basically an estimated overhead. At the beginning of the year, you have to take estimated overhead. Okay, And then what happens now? Every month, let us say Jan, Feb, okay. Every month you are having certain number of orders. Okay. So if, let us say, I have, okay, normally it will not be like that. 10% orders in January and 10% in February, okay, of the total. What I will do is, so when I give bill, as soon as the work is over, I will have to give bill to the customer, correct? But the overheads still are estimated. So what I will do is, I will use this overheads, okay, and take 10% of this, okay. 10% of this is 10,000. So I will, in that bill, I will add 10% of overhead in that January bill. I'm just to make it simple, I'm showing you like that. In January, you can have 50 orders, you can have 100 orders, okay. And for each of them, you will have to apportion, or you have to give a fair share of overheads, okay. So when these overheads are loaded into the final products and sent, okay, in the bill, okay. So that is that process, okay, fine, which is called as cost absorption, right? So cost absorption basically is when you load overheads, okay, to individual bills, okay. So that is called as cost absorption, fine. So cost absorption is the final thing. So your cost, when are you actually charging this cost with your actual revenue in absorption state, okay. So here I am giving to 10%, 10,000 is overheads. Let us say material is worth 5,000, okay. This is overheads, material and labor, okay. This is, let me say 8,000, okay. Now, and whatever are the other expenses, okay, take another 5,000. So now I know that these are my costs, okay. Now I know that these are my costs, and say that if I just find out what the total of it is, 28,000, okay. And my revenue from the customer is say 40,000, okay. So this is my first real revenue, and I have, matched up my costs with the revenue for the first time, because this is the time I've got the revenue. Before this, I did not have that revenue. So allocation, okay. Sorry, I'm just not allocation, it's absorption, okay. So absorption, when you talk about absorption, allocation and other things, they are the initial ways of distributing cost, okay. Apportionment, allocation, you do it. But when you talk about absorption, okay, it is the final loading of costs to the bill which you give to the customer, okay. And here you actually get to know that for this bill, what is your profit. Here it is 12,000, fine, got it. So this is your cost absorption, right? So ultimately, indirect cost or overhead have to be distributed to the final products. This is called as absorption, okay. So methods used, basis for absorption are direct material cost percentage, direct labor cost percentage, prime cost, okay. Direct labor hour rate method, machine hour rate method. So these are what has been written here, okay. These are the basis of absorption. So what is done is, you come to know that now this is your total overheads, like 1 lakh is the total overheads, and you also see what is the total material required, okay. So you come to know of a ratio that for any order, okay, if I know the material, I will be knowing the material what I have put, right? So if I know the material, okay, if I know the material, say it is 10,000, I will know that overhead for this will be, let us say 120%, okay, or some percent. I will be able to form a relation, because here I know the total overheads, here I know the total material, okay. Total material is say 1,20,000. So here I come to know that your overheads are 120% of material, okay. That's the general relation. Now this is how the loading is done. Whatever material you get, okay, you just load 120% or whatever percent it is. Okay, same thing. Sometimes you do it on material, sometimes your overhead has a direct relation with labor. Then you can do it with labor. Okay, sometimes the overheads are loaded with machine hour rate. You know the total machine hours used are 5,000 hours. Okay, and total overheads, let us say, are 10,000. Right? So for every hour, you know that 2 rupees of overheads are used. So you load it as per machine hour rate. So it depends on what kind of production process it is, right? So you can load it on any of these bases. So why these bases? Because you have a predetermined relationship with overhead. Okay. Now just think, annual overhead you have, right? In 1 year, if you are having say 1,000 orders, each of the order you cannot measure the overhead separately, right? So you have to do it on some basis, right? Select the basis after careful careful maximum accuracy of cost distribution to various production units. Okay, so it depends basically on you go for whichever of these bases you go for. It depends on which has a more direct relation with the overhead. So it is different in different industries. Okay, right? Fine. So basically just go for whichever is the better suited data. So as I know, we go ahead, we'll do more methods of costing and all. You will get to know in which industries, okay, which basis is used. So normally there are some industries where only one particular basis is used. Okay, whatever is there, but as cost accounting student, we should know how to apply all these bases. Fine. Now, next part what we are going to talk is called as conversion cost. Okay. So basically, what is the production process? You take material. Okay, you start with material. And now in this material, what do we do? Okay. You start processing it, you apply labor. Okay. You apply machines, other factory overheads. Okay. And then you use office expenses also on this. Okay, so all these things on this material, we are applying all of this basically, correct? So wages are used for conversion. Then you have, let us say, you are using some machines. Okay, then other factory overheads. Okay, all these things, what are you doing with all these? You are basically converting the material into a finished product. Okay, in the end, then you also use some office overheads. Okay, selling and distribution overheads, all that. Fine. So this is what we do. So basically, what do we do? We are actually converting material. So the concept of conversion cost, what it says is, okay, material is what you are buying as it is. Okay, you are not adding any value to material. So that's why let us see all these costs. Okay, so this is what actually is the value which we have added. Material we have procured as it is. Okay, which is why sum total of these is called as conversion cost. Cost of converting raw material to finished product. Okay, so this is called as conversion cost. Okay, the sum of direct material, wages, expenses, overheads of converting raw material to finished products. Okay, or converting material from one stage to another where there are multiple stages. Okay, other way of finding out is take the total cost. Okay, total cost less cost of direct materials, that we can do, right? Total cost of everything less cost of direct materials, that will give you conversion cost. Fine. So indirect materials, consumable stores, everything is included. So here we are not saying, when we talked about conversion cost, we didn't talk about excluding anything. Whatever cost, direct or indirect, which you are using to convert, okay, raw material to finished product, all cost will be included in conversion cost. Only thing you will not include is material. Okay. Okay. If So sometimes cost of material is fluctuating. Okay, it is, it fluctuates a lot. So for various reports, to get a proper basis, you have to use conversion cost, which is stable. Okay, this is also one reason where conversion cost is used, where material fluctuates. Okay, sometimes material is given by the buyer and you only manufacture and give him. So that case, what you are doing is conversion. So you have to follow conversion cost basis. Okay, right? So you have to, and of course, any cost which you incur, you have to compare it with previous periods. You'll come to know how efficient you have been. Okay, this is conversion cost basically. I hope you have understood the logic of conversion cost. Okay, all cost except raw material, that is conversion cost. Okay, now we are going to two concepts, two important concepts, which are cost control and cost reduction. Okay, so let's start with cost control. Okay, so definition is regulation by executive action of the cost of operating an undertaking. Okay, so particularly where such action is guided by cost accounting. Okay, so cost control is nothing but you would be learning standard costing and marginal standard costing and budgetary control. Okay, as we go on, standard costing and budgetary control. So in standard costing, what you do is, in standard costing, what you do is, okay, you go for you set a standard for manufacturing, say 1 unit of product. So how much material is needed, how much labor is needed, how much should be needed. Okay, you uh, go for some industrial tests and all and find out that, okay, for this unit, this much material is needed, this much labor is needed. Okay, so the total cost should be this much, let's say 50 rupees per unit. Okay, so whenever it is more than this 50, you see which element of cost has exceeded. Okay, and that's how you come to know the variance. Okay, and then you can take action on this. Okay, so standard costing is a technique of cost control. Similarly is your budgetary control. Okay, this similarly is your budgetary control. Okay, it is a, it is also a technique of cost control. Here you are comparing 1 unit of product. Okay, here you are comparing what, 1 unit of product. But here in budgetary control, you have a total budget, say for a quarter or a year. Okay, and then you see whether that particular budget is being exceeded or not. You have a baseline, okay, that this much should be the cost of the quarter or year, okay, or a product. Okay, total cost for manufacturing, okay, certain units of a product. You have certain budgets available. Okay, so now in this case also, you are seeing that you should not exceed the budget. Okay, so this is also cost control technique. So best examples of cost control are standard costing and budgetary control. Any baseline which you are using to control costs is cost control. That's why it is said here, defined as regulation by executive action, means the standard costing and budgetary control. Okay, this is put into action under some manager. Okay, so that is this executive action they are talking about. Regulation by executive action of costs of operating. Okay, it can be any cost. It can be at the undertaking level. It can be at any level below it also. Okay, any cost center or anything like that. Okay, so that is your cost control. You are regulating the cost. So what are you doing? You are setting some standards and trying to adhere to the standards throughout the period. That is your cost control. So what are the steps in cost control? First is plan. So whenever you plan in standard costing or budgetary control, you plan and set up that figure which should be followed. So following that figure, you have to do many things. See what happened in the past and see what is the proposed future price and all that. And then you have to set a standard. Okay. So there are many steps which are done, and then you set standards. Okay. So it starts with planning basically. Right? First step in cost control is establishing plan targets. Plan can be budget, standards, estimates, or past actuals expressed in monetary or physical terms. This is some standard you are giving that you have to reach this. This is a standard. Okay. So when it is scientifically determined, it becomes standard costing. But when it is driven by budget, it becomes budgetary control. It can be some other basis also. Okay. So these serves as yardsticks by which planned objective can be assessed. Okay. So first thing is what step in cost control is planning. Okay. There are these things you should be able to write. Okay. Even without seeing. Steps in cost control starts with planning. You first need that figure, right? By which will be your guiding figure. So plan for it. And after planning, you have to tell that to everyone that this is your standard. So communication. Plan and policy laid down by the management are made known to everyone. Okay, there are two directions of communication: top to bottom, bottom to top. Top to bottom is the standards will be communicated. Bottom to top is the results will be communicated from bottom to top. Okay, fine. And third step is said to be motivation. Okay, third is motivation. Right, so these are kind of questions you will not get time to study at the end. Okay, so which is why I say that as and how the lecture gets over, just try to finish it. Don't try to learn everything. You will not be able to learn these many things. Okay, I'm telling you very honestly, if I'm giving you these notes, like I've sent these notes, if you want to learn, okay, you can only learn or keep in mind 20% of what I've said. I'm telling you very honestly. Okay, you might feel no, I can remember everything. It doesn't happen. So which is why it will be important for you to break it up. For these things, you only should remember these names: planning, communication, and internal things you should be able to write. Okay, so just remember it like that. Whatever I've said, just think of it and just remember in a minute. Okay, planning is this is this, like that. Okay. So it should be such that this chapter 1 should be so well prepared, maybe with a couple of revisions later on, but it should be so well prepared that before the exam you should not be able to, you might not get time to go through this again. Still you should be fine. Okay. So all of you who have attempted the exam at least once, okay, they will understand what I'm talking about. That in the end there is so much pending and so little time, right? So things which you have done and you need not see, that helps a lot, correct? So that is our plan. That's what we will try to do. That you will have things which you can you just complete and move it aside, kind of. Okay, fine. So I'm really telling you that of the whole notes of chapter 1, you can only remember 20% of the content. So you will have to crunch these things. Okay. So these sentences and all things, there's no question of learning it. So motivation. Third is motivation. Plan. Now, why it is called as motivation is motivation actually is, it is the implementation stage. Okay. The motivation is implementation stage. So it is called, the name, they have given a fancy name, motivation, because what they are saying is that once the plan is given effect, performance starts. Okay. So when results are achieved, everyone is motivated because they know that their performance will be matched with the standards. That's how their performance will be analyzed. And if they get, say, a better hike or anything like that, it will be based on that. Okay. So people will be motivated. That's what they are saying. It will be a motivating force for all of them. That's why implementation has been named as motivation. Okay. And only 5 steps are there. Okay. Next is appraisal and reporting. Okay. Then after performance have been done, then you get the results. To get the result, actual performance will be compared and variances will be found out, and they will be reported to the proper level of management. Okay, the fourth one is at the fourth stage, you have the results with you. You have standards, you have results. Compare whatever variance is there, report to the higher management. Okay. Last is decision making. Variances are reviewed and decisions are taken. Okay. If corrective actions are needed, then they are taken. So this is the action of the top level manager, or whoever is the head of that activity. Okay. Whichever level is the head of that activity. They will take decisions, okay, and corrective actions. Fine. So this is our steps in cost control. Okay, 5 steps are there. Okay, planning, communication, motivation, okay, appraisal and reporting, and decision making. Okay, fine. These are the 5 stages. So if you just remember these 5 names, okay, you should be able to write what is inside. Okay, you have to prepare like that. Otherwise, these definitions and all, no, you cannot even, like the one full-fledged definition I am talking about in the whole subject, you can hardly learn 5 such definitions. Definitions which have that complex meanings, you know, in the whole subject. Your mind will not support more than that, more than 5. So you should know how to write in your own words. Okay, truncate things, get the concepts in your mind. Okay, so whatever it is, like what I have observed is basically, you know, you can fit lots of concepts in your mind. Okay, but just this rote memory, you know, where you are blindly learning, that you cannot fix too much. Right? So the next is advantages of cost control. Now these are again that advantages, disadvantages point. What are the advantages of cost control? Okay, you will reach your target. So here it's expected return on capital by maximizing profit. Okay, if you have reduced your cost, of course your profit will be more. Okay, increase productivity. Productivity will increase naturally. Okay, when you have kept a tab on the cost. Reasonable price for customers. If your cost is less, customers will also get at a reasonably lower cost. Continued employment. See, if you are following cost control, then your organization will be successful. Organization is successful means employment of the workers will also be guaranteed. Okay, fine. Economic use of limited resources. This I need not explain, right? Increased credit worthiness. So if your organization is successful, banks will give you credit because they know that you will be in a position to repay them. So their credit worthiness will be more. Fine. Prosperity and economic stability of the industry. Okay? No need to explain this. So these are the things, these are the advantages. So at least 4 or 5 points should be there in your fingers always. Okay. So just finish this off. I would say finish this chapter. You have time till I will give you a test on this. After 2-3 days, I'll give you a test on this. Okay. So finish this chapter by then. Okay. The way I told you, don't go for learning, go for understanding. Okay. Finish it like that. Fine. Then we will have, I will load one objective test for this also with 15-20 questions objective. Okay, and then a theory test of this. Appear for all tests. Okay, it's okay if you're getting very less marks, I'll not say anything. Okay, but you should appear. It will make a big difference. Big means very huge difference. So appear for tests, right? So now next thing is cost reduction. Okay, cost control we have done. Next is cost reduction. Cost control is what? You take a base, okay, and based on that base, you will control your cost. Okay. Say if I given you a budget of, okay, I've given you a budget of 5 lakhs. Okay. So I have given you a budget of 5 lakhs. Okay. So I have say I've given you a budget of 5 lakhs. So what you will do is you will adhere to this budget, correct? You will try to adhere. So in the end, say you have spent exactly 5 lakhs. Okay. But it is possible that I have given you more budget. Actually, I should have given you 4 lakhs only. Correct? It's possible. But if you have a budget of 5 lakhs, you will try to spend the whole thing. Correct? Right? So this is one part of cost control where if the standards are not correct, then your real performance will take a hit. Okay. So this is taken care of by cost reduction. Cost reduction sees it doesn't set a target and all. It doesn't. That's not the purpose of cost reduction. It sees that is 5 lakh required. That is the thing it will see. If it is not required, if it gets proper proof, then it will say that for this activity 5 lakh is required. It will say no, only 3 lakh 50,000 is required for this activity. It will do its research, okay, and give you this. So this is cost reduction, and this will be a permanent reduction, because this cost reduction will achieve in a way like it will say that you are purchasing from supplier A. Okay, he is quoting costly prices. Go to supplier B. Okay, so this way, this much cost has come down. Okay, similarly, many things it will say. You are say, buying equipment from this person, instead of that, buy from someone else. Okay, and many things it can suggest. It might say that you are buying oil every month. Buy oil for say once in 6 months or 1 year, then we can get a good cost. Something like that. It will see certain administrative way of reducing this cost. Okay, that is cost reduction. So now the profit is a result of two varying factors, sales and cost. Okay, wider the gap between these two, more is the profit. Fine. When competition comes into play, you cannot increase sales price. Okay, because if you increase sales price, people will go to your competitor. Okay, so that's why what you can do, you only have to reduce the cost. Cost is the only thing you can work with, right? As I told you in the first class also. Okay, so if you increase it, if you still want to increase it, okay, what will happen is your profit will reduce. One reason can be your customers will go out. But if you increase the selling price, another thing that can happen is the person who is supplying you material, he will also increase his price. He will think he is gaining a large profit. So why not I also gain more profit from him, correct? So material, labor, and labor will also say that there's more profit, give us more wages. Okay. So everything increases. If the cost of one thing increases, entire chain increases. Okay. So which is why it is a better idea always to work with your cost than with the selling price. Okay. So and then so it has an effect of pushing raw materials and all that. Okay. And another thing what can happen is, okay, another thing that can happen is substitute products may come up in the market. Okay, so there'll be more products will come up who might give it at a cheaper rate than yours. Okay, so which is why always best way is to reduce the cost, and that way you will stay very competitive. Okay, so always go for cutting down the cost. So now, so what is cost reduction now? Maximization of profits by reducing cost through economics, savings in cost of manufacture, administration, selling and distribution, etc. Okay. So it's a permanent reduction of cost using economics and other savings. Okay. That is your cost reduction. Cost reduction doesn't go for any standard and all. Okay. It basically challenges even the standards. Okay, definition is real and permanent reduction in the unit cost of goods manufactured or services rendered without impairing their suitability for the use. Okay, so it is still as useful as before the product. Okay, reduction should be real and permanent. Reductions for due to windfalls. Windfall means out of luck sometimes your cost gets reduced. Okay, so then as due to luck it reduced, due to again it will come back to normal. Okay, so cost reduction is not that, you know, say for example a new government has come, it just wants to reduce the cost just to be popular. Okay, and it has reduced the cost. In 6 months again it will come back to the normal range. Okay, fine. Or so if say any other government policy has cost reduction, so these are not cost reduction. You have to use economics. Okay, and you are reducing using economics. That is cost reduction, not these things. Okay, cost reduction should not affect the quality of products, obviously. Okay, you want to give the same utility to the customer. So broadly speaking, reduction in cost per unit of production may be affected in two ways. How can you reduce it? Reducing expenditure, okay, volume of output remaining constant. So you can, there are two ways of reducing actually. One is what we were discussing all this while, reducing expenditure and volume for the same volume, okay, using economics. Second is you increase productivity. Okay, so earlier you were in the same amount, same cost, you are producing 100 units, now you produce 110 units. Okay, so naturally the cost will get reduced. Okay, there are ways of reduction. Fine. So now I will give you a break. Okay, so now I will give you a break and then we'll come back and do difference between cost control and cost reduction. Okay, so you can come back at, let's say, 7:20. Okay, fine. 7:20, you can come back. Okay, so welcome back. We will continue. Right. So next point is difference between cost control and cost reduction. Okay. So we'll see the difference between cost control and cost reduction. Now, certain differences you can directly say without even seeing anything. Okay. Cost control uses standards. Cost reduction doesn't use standards. Okay. And many other things you can say about cost control, which will be related to standards. Okay. So cost control, one more point you can say is cost control, uh, cost reduction can have further reduction than what is seen by cost control. Okay. So cost control can reduce even standards. Okay. So same thing is not cost control. Cost control might not be giving the best possible figure. Okay. Reduction gives the best possible figure, lowest amount of reduction. Okay. That you can do. Right. So similarly, there are several points which you can just remember, and you can just write 4 points. Nothing, it's very, very easy. Okay. You know the concept of cost control and cost reduction. 4 points very easily you can write. And more than that, you need not write. Okay. So let's see here. Cost control represent efforts made towards achieving a target or goal. Okay. Efforts made towards achieving a target. Right. And cost reduction. Cost reduction represents the achievement in reduction of cost. Okay. This is achieving a target, achievement of reduction this side. Okay. Then process of cost control. Okay, if a target is set up, then you ascertain the actual performance and compare with it, correct? And investigate variances. Just your standard costing thing, whatever you do, that is the process. Okay. Cost in cost reduction, what you will say is, okay, cost reduction is not concerned with maintenance of performance according to standard. Okay, we don't talk about standards here, right? Whatever reduction is possible, that you will see. Fine. So here, what first point, what was it? That it is the effort towards achieving a target, and this is achievement in reduction, of course. Second is, say, the process. Process is why what we will set a standard. Okay, get the actuals, get the variance. Okay, and try to investigate the variance. Here, it is not concerned with maintenance of performance in comparison with a standard. Okay. Then cost control assumes existence of standards or norms which are not to be challenged. Okay. The cost control assumes existence of standards or norms which are not to be challenged. Fine. And what about cost reduction? Okay, it assumes concealed potential savings. It says that even in your cost control, even in your standards, there can be concealed savings which can be brought out. Okay. And this is a preventive function. Okay. Cost control is a preventive function because it is just preventing cost from overshooting. Okay. Fine. And this is a corrective function. It is just correcting any less. I mean, if you are paying more cost, then it is correcting. It's a corrective function. Fine. It can even operate even when an efficient cost control system exists. When you have got very good cost control system, still you can find out cost reduction. Okay. So that is the thing. So one point basically is cost reduction will operate even when there is a very good cost control system in place. Okay. Cost control, it can be any new thing you have discovered by which you have reduced cost. Okay. Okay. Cost control lacks dynamic approach. Okay. Because it is only seeing one target and going for it. Okay. It's not going beyond it. It lacks a dynamic approach. And cost reduction is a continuous process of analysis by various methods of all factors affecting cost, efforts, functions in organization. Wherever you can find reduction, you will go for it. Main stress is on why of a thing. Okay, why this much cost? Why not less? Okay, and the aim is continual economy. So these are basically the points you can easily, as I said, you can from your own mind you can write, get 4 points out of your own. Okay, cost control and cost reduction. Now, next part we are coming to is classification of cost. Okay, how to classify cost into various ways. The arrangement of items of cost in logical groups based on nature or purpose. Okay, to pick one base, and based on that you will classify the cost. Okay, so we will also be studying cost accounting standards, okay, which is one of your chapters. The basis for, as per CAS 1, okay, cost accounting standards are called as CAS. CAS 1 basis for cost classification are as follows. You can classify using any of these bases. Okay. So one is nature of expense. Okay. One is basically the nature of expense. Okay. We'll see here. Right. So all these are basically your broad points, nature of expense. Then you have relation to object. Okay. Functions, activities, then fixed or variable, that kind of, then whether it is for management decision making or not, production or process, time period. Okay, so we're going to see each one of these now, starting with nature of expense. So there are one main classification is material, labor and expenses. Okay, material, labor and expenses, these are the main classification based on nature, right? So in these expenses, all your everything comes, all other expenses comes within these expenses. Okay, maybe your factory expenses, your office expenses. Okay, material cost is what? Cost of material. Okay, used for production or service. It will have cost of material. Okay, freight inwards. Okay, for that is the carriage for bringing in the materials, taxes on buying materials like GST and all, insurance, etc., directly attributable to acquisition. Okay, but you have to exclude certain things. Trade discount, that is, trade discount should not be a part of the material cost. Duty drawbacks. Okay, duty drawback is any drawback of duty, that is any duty which you did not have to pay eventually, so it will reduce your cost. Okay, so which is why you will always see cost post duty drawback. Okay, and uh, and GST refunds, etc. Okay, so you will exclude these things from material. Fine, this is your material cost. In general, like we know how we compute material, basically you get all carriage inwards and whatever cost you are spending on machine, you take, and anything which is reducing the cost of machine, material, you have to remove that. Okay, fine. Right, so when we say exclude, means if it is there, okay, if you have not included it in it, just deduct it. Okay, deduct all items which are reducing your cost. Fine. Next is labor. Labor is salaries, wages, but point to remember here is it can be to permanent, temporary employee or contract employees. Okay, and any benefits you are giving to employees like PF, gratuity, it will also be labor cost. Fine. Then expenses. Okay, uh, expenses are other than material cost or labor cost, which is any expense, any other expense which is not material or labor. Okay, that will be expenses. Fine. So these are basically your first classification by nature of an expense. Okay. And then next is classification in relation to cost center or cost unit. Okay. If expenditure can be allocated to cost center or cost object in an economically feasible way, then it is called direct. Otherwise, indirect. Okay. Here we are talking about direct and indirect. Okay. So material cost is divided into direct material, indirect material, labor into direct, indirect, and expense into direct and indirect. Okay. Indirect cost is called as overhead. Indirect material, indirect labor, indirect expenses, overhead. So here, no, when you classification by relation to cost center or cost unit. Okay. So in this, see, I'll tell you one thing, direct or indirect. See, we all know that you have cost sheet. What do you have? Okay, material, labor, okay, and expenses, direct expenses. Okay. This gives us what? Prime cost. Okay. After this, you have factory expenses. Okay. I'm just ignoring the opening and closing stocks. Factory expenses, you get factory cost, or which is also called as cost of production. Okay. And then you have office cost. Okay. Which is called as, yeah, okay, cost of, okay, this is basically your that is cost of manufacturing. Okay. And then you have, okay, after this you will have this is basically, you call it cost of goods manufactured. Okay. Manufactured, right? And after this you will have, you just add and deduct your opening and closing stock of finished goods, and you get, okay, cost of finished goods sold. Okay. And then you add office expenses, sorry, you add selling and distribution expenses, and you get cost of goods sold. Okay. So mostly what happens is your selling and distribution is added at this stage only. Here itself you get cost of goods sold. Okay. It depends on like what format is being followed. Okay. So this is how generally it is done. So here why I showed you this is, okay, and if I want to show the same thing in trading and P&L, okay, this material till prime cost, it will come in your trading account. Okay, fine. And after factory, it will come in P&L account. So there is something called as absorption costing, which we will study in the next chapter. Okay, marginal costing. So absorption costing is called full cost basis. In absorption costing, what happens is till your prime cost, okay, it is considered as direct cost, right? Same happens when you put trading and P&L account. This will be your direct cost, okay? And below whatever it is, if I take all this, okay, I put, let me put it. Okay, fine. Let it be, no problem. So here, so below whatever it is, no, this will be treated as indirect cost. Okay, fine. But when you talk about uh, relation with the cost object, okay, when we classify as per relation with cost object, then what happens is entire factory expenses doesn't become indirect. Okay, there are some part of factory expenses. There can be a machine which is used directly for producing one product only, such that the entire cost of the machine you can load to this product. Fine. So it has a direct connection with the cost object, correct here. So then this machine will become a, okay, this will be direct cost for this product. Okay, it will no longer be indirect cost. So it depends on see what basis you are using for classification. Okay, if I classify two students, okay, student 1 and student 2, okay, I can classify. What can be the basis I can use? I can classify based on height. I can classify based on color. Okay, I can classify based on intelligence. Okay, I can classify based on politeness. Okay, there are several ways I can classify. Okay, so if I am using height, then maybe student 1 will be first, this will be second. Okay, and say if I'm using intelligence, then it might be other way around, he will go on top. Okay, so what I'm trying to say is, your whenever you classify, it depends on the base you use. Okay, so based on the base, the classifications will change. Correct? Understood? So which is why here, when you classify as direct and indirect, okay, as per cost accounting, so what you see is direct relation with cost object. So it is not till here only that can be direct. There can be more things which in PN, which we show in PNL. Okay, that is which is supposed to be indirect. Okay, but it can be seen as direct because it has a direct nexus with the cost object. Got the point? Getting the point what I'm trying to say. Okay, so this is classification in relation to cost center or cost unit. So when you use this, okay, there can be some item of factory expenses also which will become direct. Fine. Okay. Then, so basically you can just say that there will be three classifications here: direct material, direct labor, direct expenses; indirect material, indirect labor, indirect expenses. So all indirect what you are classifying here should not have a direct nexus with the cost object. Fine. So now just a small write-up of direct material cost. It can be directly allocated in an economically feasible way. We have seen that. Wages, which can be directly linked to a cost center or a cost object. Okay. Then direct expenses, whatever expenses other than direct labor and direct expenses, but which are direct. Okay, linked with cost center or cost object. And now here we have seen this earlier. Direct material, direct labor, and direct expenses is equals to prime cost. Okay. And same now, indirect material, these three will be indirect. Okay, anything which is indirect. Okay, so cost of material which cannot be directly allocable to a particular cost center. You have to apportion it to many cost centers. Okay. Then indirect labor, which are not directly allocable, same thing. Okay. And there is any other expense which is indirect, okay, but which is not indirect material and indirect labor, that is indirect expenses. Okay, got it? So indirect material, indirect labor plus indirect expenses is called as overheads, right? If you have any questions, you can stop me and ask. Okay, not just in this chapter, in any other chapter. If you have some other doubt of a previous chapter, or okay, maybe whatever you have studied here now, with some other chapter you can get a doubt, you can ask me then also. Okay, so now this was the second classification. Okay, now we are going to the third classification. Okay, classification by functions. Okay, now functions means, okay, if for all factory cost will be called as production cost, administration cost is office cost, selling and distribution. So these are the functions, various functions of the organization headed by different people. So you can classify as per this functions also. Okay. So production, any cost of production will be manufacturing costs. Okay. So will all manufacturing costs be indirect? Not necessary. Okay. So basically, when you talk about manufacturing cost, this means we are talking about factory cost. So here in the cost sheet, okay, only factory expenses if you want to talk about. Okay, it's called as factory expenses, factory on cost, works on cost, or factory overhead. All these are same things. Okay, so basically, so these are the various ways you can write factory overhead. But now before this, what you had? You had material, you had labor, fine, and you had direct expenses. Okay, all this totaled, we got prime cost, correct? So when you add this prime cost to factory expenses, okay, when you add prime cost to direct expenses, what you get is called as factory cost. Okay, or manufacturing cost or works cost, same names. Fine. So which is why this is called as factory cost if you add these two. So when I say factory expenses, it means this sub part. Okay, it doesn't include prime cost. But when I say factory cost or manufacturing cost, it includes this also. Right. So similarly, here they have used the word cost, right? Cost means it includes, okay, raw materials, labor, services, whatever before production you have incurred the cost, it will include all of these. Okay, fine, fine. And okay, so basically incurred by the factory, right? All the costs, even before the incurring of factory expenses, everything will be included. Okay, in this, right? So they have said here, and the finished product is packed with primary packing. It means till the goods go out of factory. Okay, till that time. So so factory cost will include all that. Now the following are considered as production or manufacturing costs. What are production or manufacturing costs? Direct labor, direct material, direct expenses, and factory overhead. Okay, these totally will be called as production cost, manufacturing cost, okay, works cost, okay, any of these, right? Fine. So manufacturing cost is equals to prime cost plus works overhead or factory overhead. Fine. Last is administration cost is office cost. Okay, for general management of the organization. These are always indirect. Why these are always indirect? Because uh, you won't incur a particular administrative expense just for one product. Okay, it will be for everything in general, right? So which is why these are always indirect costs. Okay, and administration function does not include production, selling and distribution, R&D. Okay, so in administration cost or administration expenses, you do not include production, any management expense for production, supervisor and all that. Factory supervisor will be charged to factory cost. Okay, and your selling and distribution supervisor or R&D supervisor, he will be charged to R&D, not in administrative costs. Okay, fine. Administration cost is a cost of administrative function. Okay, that is the cost of formulating policy. Okay, directing, organizing, controlling the operations of the undertaking. That is administration cost. Okay, and what all things come in this? Okay, is number one, salaries of office staff, accountants, directors, rent rates of and depreciation of office building, postage, stationery and telephone, office supplies and expenses. Okay, postage, stationery, it is all normally, it is for office use normally. Okay, so general administration expenses, all these come under administration cost, right? Last is selling and distribution costs. Okay, selling costs are again indirect costs. Okay, the selling cost also, because most of the selling cost advertisement, they are not incurred for one product. Okay, if you can find any selling cost or anything which is just for one product, it can become direct, but it doesn't happen like that. Okay, so these are all like office expenses. This is incurred in general for the company, right? When you give an advertisement, okay, it will be for all the products of the company, right? So normally speaking, these are indirect costs, right? And includes indirect costs in sales management for organization. There's difference between selling and distribution. Okay, selling is all advertisement and anything you do for better selling of products of your company, that is selling. Distribution is just to take the finished product from the factory and deliver it to the warehouse or any other seller's location or to any customer directly. Okay, that is distribution. Distribution is only delivering of finished products to the end customer. Fine, end customer can be your wholesaler also, whatever, your end customer. Okay, right? And selling is the brain of selling division, selling part. Okay, so all major managers will be there in the selling department, not in the distribution department. Fine. Okay, cost for handling a product from the time it is completed till it reaches the ultimate customer. Selling function, create and stimulate demand of company's products and secure orders. Its job is to help in selling of the products, proper advertising and all that. Okay, and distribution is just make saleable goods available in the hands of the customer. Okay, now let's see the examples of selling and distribution costs. Salaries and commission of salesmen and sales managers. Any doubt anywhere, just stop me. Okay, and expenses of advertisement, insurance, right? See, insurance, you can do insurance for office also, which will become office cost. Okay, you can do insurance for factory products also, factory machines and all, that will become factory cost. Okay, so insurance basically depends on what insurance you have made. The classification will change. Okay, rent rates, depreciation and insurance of sales office and warehouses. Okay, cost of insurance, freight, export duty, packing, shipping, etc. Okay, anything, these are all, if you see all these are all relating to dispatch of the products. Okay, so this freight is not to buy material. Okay, that will be material cost. This freight is to dispatch the final product to the customer. Okay, fine. Then maintenance of delivery vans, obviously it will be a distribution expense. Fine. Last one, sorry, this is the last one. Okay, classification on the basis of functions, that is research and development cost. So this is cost for research, as you all might be understanding. Okay, research can be to improve a present product, or you are working on some future product. Okay, it can be anything. It's also done on market research. Okay, to understand how the market works, you can do research for that also, right? And in research, there will be two parts. One is the research Second will be commercialization. They're saying here, right? Commercialization. It means that once you get the results of research, then you have to apply it to the reality. Correct? So implementation part. Okay. So that implementation part is actually called as development. Okay. Fine. So some examples of R&D. Okay. Development of a new product, improvement of existing products, finding new users for known products. This is also research. Finding new users for known product. So you have formed a research team to find, so this is my product, uh, where else can I sell this product? That they have done the research, say, for 3-4 months or 6 months, they have done research on that. That will be an R&D cost. Okay. Solving technical problem arising in manufacture and application of products. Okay. And it's solving any technical problem. This will not be regular problem. Okay. It's something which cannot be solved by the regular workforce, and you have to research on it. So development cost includes the cost incurred for commercialization and implementation of research. Okay. Development means when you implement the research findings. Okay. So this completes our classification on the basis of function. Okay. Now there's one thing, one term which we have to see here. It's called as pre-production costs. Okay. As the name suggests, it is cost before production. Okay. So you have say established the factory, everything has been done. Then there are certain costs. Okay. Before you do the real production, you have to incur some costs. Okay. When a new factory is in the process of establishment, okay, or a new product line is started, you have no formal production for which the costs will be charged. So you have started something new, you are incurring costs on that. Okay. For that. So, but you don't have any production as of now, right? Because you have not started the production, but costs are being incurred, isn't it? Okay. So these costs are treated as deferred revenue expenditure and charged to cost of future production. Okay. For example, if I have started my factory, okay, and it took me 1 year to start production. Okay. In this 1 year, I have incurred 10 lakhs expense. Okay, this will be pre-production cost. Okay, so this what I will do about this is I'll spread it in the future production. Let's say 2 lakhs next 5 years. Okay, so you can do something like this. This is called as deferred revenue expenditure. You are deferring it to many years. Okay, fine. This is called as pre-production cost. Right. Next classification is on the basis of fixed and variable. Okay. So fixed. Okay. Next classification is fixed, semi-variable, and variable. Based on its rate, it is called as behavioral study. Classification on the basis of behavior. So fixed cost does not change with the volume of activity. Okay, this part is what we are going to study in detail in marginal costing. Okay, from next class. So fixed cost does not vary with the change in volume of activity. Okay. So that means fixed cost is something like rent, depreciation, etc. They're called as period costs. Okay. So it's like for 1 year, 1 month, like that it will be incurred. Okay. And with change in production, that cost will not change. Now, if today you are manufacturing 1000 units. Okay, this month. Next month it is 2000 units. Will the rent change because of that? No, right? So rent will not change. So this is called as fixed cost. Now variable cost is cost for each unit. like material, labor, they are all variable cost. For each unit you have to incur, which every new unit variable cost has to be incurred, correct? Cost of elements which directly varies with the volume of activity. Okay, it has two parts: variable direct cost, variable indirect cost. Okay, so variable indirect costs are termed as variable overheads. Okay, you can have variable some direct cost also. Okay, and you can have some indirect cost also. Okay, in variable overheads. So variable here is like you are incurring, you have to change, you are incurring with every different unit. Okay, that is the thing which is to be observed here. Okay, so this is your variable cost. Okay, then last in behavioral study is semi-variable cost. Certain things are such that um, it will be fixed, some part will be fixed, some part will be variable. Okay, so when you go for mobile plans and all, you will find that this plan they will say is for rupees 200. Okay, 200 is the fixed. Okay, and then your billing will be 50 paise per call. Okay, so this is fixed and this is variable. Okay, so which is a more the call you make, more will be your cost, but it will not be in a direct proportion. Okay, so in variable what happens is it increases in a direct proportion. If 200 were variable, it will become 400, 600, 800. So in graph straight line will come. Here increase is there, but it is not in a straight line. Okay, so that's why it is called a semi-variable expense. Okay, best way to find it out is you will never have a straight relation. So okay, in semi-variable expenses, but it will increase, it will go in one direction. Okay, but not proportionately. So they contain both fixed and variable expenses. Okay, partly affected by fluctuation in the level of activity. Fine, they are partly fixed and partly variable. Okay, so these costs are going to be in part it will be fixed, in part it will be variable. Because of that, it will not give a reasonable, it will not give a linear relationship. Okay, in graph. Example, factory supervision, maintenance. Okay, see in maintenance what happens, you know that more you use a thing, the earlier it will break, or I mean it will become useless earlier. For example, take tires. Okay, in tires, if say I say year 1, okay, year 1, year 2, year 3, year 4, year 5. Okay, so if I have bought a new tire, normally I think it works for 5 years. But if I am going for too much overtime or something, okay, then it might be useful only till year 3. It is possible, right? So this is an example of semi-variable. Okay, you cannot tell directly, right? Like you use this much, it will come this. You use this much, it will only go through till here. You cannot say that. Okay, so it is an example. So maintenance is always an example of semi-variable. When more usage is there, the cost is more, but not in direct proportion. Okay, fine. So these are some of the examples of semi-variable costs. Okay, fine. So now supervision is like normally it will be fixed, right? But if supervisors have like normally a fixed salary, but if normally if they do more work or something overtime kind of a thing, if it is added, then it can become a semi-variable cost. Okay, right? Normally, see most of the employee cost wherever there is chance of overtime, it can become a semi-variable cost. Fine. Now, the next is classification on the basis of costs for decision making. Okay. Classification on the basis of costs for management decision making. Okay. So this is cost for management decision making. Okay. Here you are classifying the cost the way the management wants to see it. Okay. For them to take decisions. So this is called as marginal cost. Main thing is marginal cost. Okay. So marginal cost is nothing but your variable cost. Okay. All variable cost is marginal cost. Okay. Prime cost plus variable overhead. Right. The technical definition is change in the amount at any given volume of output by which cost is increased or decreased by 1 unit. Okay. So we will discuss this definition with marginal costing. What they are saying actually is, if you have now produced 1000 units, so cost for the 1000 first unit or the cost for 999th unit. Okay. Whatever is the change, that is the marginal cost. Okay. That is the definition of this. So for greater analysis of this, we will do with the marginal costing chapter next week. Okay. So it is what marginal cost is the variable cost, you can say. Okay. Now differential cost, the change in the cost due to change in activity from one level to another. Okay. So if say, so difference between marginal cost and differential cost, both change from one level to another. Okay. And differential cost, if I want to see, currently I have one alternative. Okay. My current operations. Okay. And if I add something else, some other work, okay, then say I'm getting new alternative where I'm retaining old one and I'm adding some work. And I want to find out what is the extra cost for this. So what I will do is take this cost minus this cost, correct? This will be the cost for the new alternative, correct? Basically from going from first alternative to new alternative, right? Isn't it? So this difference between two alternatives, this is called as differential cost. Now in this difference, there can be some fixed cost also which is changing, some variable also can change. Okay. So that is the difference in differential cost. The differential cost can also include some fixed cost. Okay. Whereas marginal cost is largely based on variable cost. Okay. When you say change in marginal cost from one level to another, we're only talking about the variable cost. Fine. Now, opportunity cost. Okay, so basically opportunity cost is, okay, this is the cost for foregoing any opportunity. Okay. So basically, if say I am doing current business, okay, and getting a profit of 10,000. So if I'm starting a new business in the same shop, I'm stopping this and I want to start new business. Okay. So if I say get a profit of 5,000, so will I be happy? No, because I already used to get 10,000, correct? So when I started this new business, I sacrificed this profit, correct? So my opportunity cost was already 10,000. So I started at minus 10,000 basically. Okay, this is called as opportunity cost. Opportunity cost. Okay, so opportunity cost is what? Cost of the next best alternative. Okay, so I'm This is my cost of living. This is 10,000 now. That's what 10,000 is the opportunity cost. So new business must give me more than 10,000. This is called as opportunity cost. Similarly, here I told you from this business to the past. Okay. Now opportunity cost can also be from this business to the future. Okay. Say now I'm getting a profit of 15,000. Okay. So I'm fine. Right. From this opportunity cost point of view, I am fine. Now I have another opportunity of another new business. Okay. Here my profit can be 20,000. Okay. So now again I can compare this with the next best alternative. So always with whatever you are doing, your next best alternative should be less lucrative than your current alternative. Okay. Otherwise you should have been doing that, right? If that is better, you should have been doing that. So as per opportunity cost theory, what you are doing right now, it must be better than other opportunities. Okay. Right. So this opportunity can be back also. Like here we have seen. So now after say you are getting more, then so this is now out of the question. Now if we have a new business opportunity, okay, then again, opportunity cost will be the cost of next best alternative for you. This is how you will find it out. So although we use the word cost, you used opportunity cost theory for comparing cost also, comparing revenue also. Okay, you can compare both, right? So this is called as opportunity cost, right? So here there's an example. If fixed deposits, so I have fixed deposits in the bank, okay, and I want to take that out and finance a project. Okay, so opportunity cost will be loss of interest. Okay, so I'm getting some interest now. So if I'm taking that money out, okay, I am foregoing that interest. So that is my opportunity cost. Okay, right? So here basically it is the value of alternatives foregone by adopting a particular strategy or employing resources in a specific manner. Return expected from an investment other than the present. Okay, this is nothing but opportunity cost. Okay, now replacement cost. Next is replacement cost. If you want to replace an asset, whatever is its current cost, that will be your replacement cost. Okay, cost of asset in the current market for replacement. Okay, it is used for determining the optimum time of replacement of an equipment. So this concept is used basically. Okay, so whenever you want to replace an equipment, okay, what you will see is your current equipment. Okay, you have a current equipment, right? So now if you are thinking whether you will replace it in year 1, year 2, year 3, when should you replace it? Okay, and replacement machinery costs 50,000. Okay, so whenever the cost of this, so whatever you are producing, of course this will be more costly, which is why you want to replace, correct? The cost per unit using current equipment will be more. So you will just compare the cost of current equipment and the new equipment. Say for example, you want to manufacture 5,000 units. Okay, so as per old and new. As per old, say you require 20,000 for manufacturing, and as per new, you require 8,000. Okay, so as per you, say new, you require 8,000. This is what 5,000 is what we are going to manufacture. So every year you have a profit of 12,000. Okay, you have every year you have a profit of 12,000. So this is the thing you will basically compare, okay, to see on which year you should replace it. Okay, so which is the year when you should replace it or you should not replace it at all. Okay, this is what you will have to find out. Okay, These are some decisions, okay, which we will see in marginal costing. These kind of decisions will also be seen, okay, where we have got two equipment, okay, and the new one with the new one production is cheaper, okay. So basically here you have to 12,000 is the additional cost for the old equipment, correct? But you have to buy this at 50,000. You're going to buy this at 50,000. But when will it get recouped? 12 fours are 48. So 4 years it will require to recoup the cost. Okay. Now, if the life of the new equipment itself is 3 years, okay, if life itself is 3 years, then it is not good. What I'm saying is, okay, although this right now it's not in our agenda to discuss this, okay, this is just a basics chapter. So here old equipment for manufacturing cost is 20,000, here it is 8,000. So 12,000 is the benefit, correct? 12,000 is the benefit, right? And how much you have to incur to get benefit of 12,000 is 50,000. So if the life of the new equipment itself is only 3 years, that means the benefit you are getting is 36,000, correct? And your cost is 50,000, then it is not a good decision. So this is how you will be comparing it. Okay. So that's your replacement cost. Okay. Now next is relevant cost. Okay. So relevant cost is certain things for certain decisions are relevant, certain things are irrelevant. For example, you have two alternative 1 and alternative 2. Okay, so you want to compare all costs to see which is better. Now, there is one shop which both are going to use. Okay, if you take this, it will use it. If you take this, it will use it. It is common among two, correct? So this cost is what you will not be considering for decisions. It is called as irrelevant cost. Okay, so anything, so relevant is something, okay, in decision making, what is different in both the alternatives. Only then it will enter your decision. Whatever is common for both, it will not enter your decision. Okay, should be relevant for a specific purpose or situation, right? So this is mainly used in decision making, relevant cost. Historical costs are always irrelevant, okay, because you have already spent it. Okay, historical cost is irrelevant because you have already spent it. Here in this the earlier example which I was showing you, so I did not consider how much this old equipment we bought for. We might have bought it for 40,000. Okay, we might have bought it for 40,000, but that is not relevant now. Old equipment cost. Okay, now if whatever cost I'm paying for manufacturing, if the difference of this is my gain, current gain. Okay, so this was more relevant for me. Okay, had this cost been, let us say, new equipment's cost would be say only 25,000, then this would have been a good deal for me. Okay, so old cost need not be considered, right? So fine, it's only the new benefits, whatever you are having, both ways, that you have to compare. Okay. So this is called as relevant cost. Okay. Then comes imputed cost. Okay. Imputed costs are notional costs, hypothetical cost, okay, which do not involve any cash outlay and used only for decision making, similar to opportunity cost, okay, but not opportunity costs. Okay. So examples for this is, these are notional costs, that is you are not paying it to anyone. Okay, right? So you are not paying it to anyone. It is only a notional cost which you have to consider for decision making. So interest on funds generated internally. Okay, payment for which is not actually made. Interest on funds generated internally. Say, for example, whatever funds you are generating, okay, whatever funds we are getting, and we want to invest these funds. So we will think about what is the interest on these funds. Okay, why we will think about that? So that we can do a better job than that. Okay, so for example, my interest on internal funds, I'm not investing it. Okay, internal funds. If interest on internal funds is say 10,000, if I invest, then it is 10,000. Okay, so when I invest it, I want to do better than this 10,000. Okay, for this comparison, I will use 10,000, although I have not invested it right now. Okay, so this 10,000 is an imputed cost. Okay, right? So interest on funds internally generated, payment for which is not made is internal cost. Okay. When alternative capital investment projects are being considered, okay, which will be financed from internal funds, it is necessary to take into account imputed interest on own funds. Okay, in certain decisions, you will have to see imputed interest because to find out, okay, which is doing a better job. Okay, it gives you, kind of some standard which you are looking at. So this is imputed cost. So basically, cost which you have not incurred, but you are considering it for decision making. Okay, that is your imputed cost. So I will give you a break now. Come back at 8:25. Okay. Okay, 8:25. Okay, so we'll come back, we will continue. Right, next is sunk costs. Okay, the sunk cost is what you have already incurred in the past. Okay, and hence it is not relevant to a particular decision. Okay, you've already incurred it, right? So there are certain things which we, for example, okay, now, okay, sunk cost will be something, say, which you have already incurred in the past, hence it is not useful for the current decision. Okay, so now, say for example, I have invested 20,000 on a machine. Okay, I have invested 20,000 on a machine. Now I have, now the current machine, I have to spend, say, annual amount I have to spend, let us say, is 10,000 on the current machine. Okay, right? And say if there is a new machine, okay, now which has come to the market, okay, including its depreciation, okay, including the depreciation of the new machine, if say I have to spend only 2,000 on this, okay, so in that case I have an advantage of 8,000, correct? I am including the depreciation of the new machine and I have to spend only 2,000 annually. Here with the old machine I have to spend 10,000. Okay, so that means here I am getting a benefit of 8,000. Okay, every year I am getting a benefit of 8,000. Okay, so which is why what I will consider is this benefit which I am getting right now. Okay, I'll be considering this for the decision. Okay, for all future, that means if say the old machine is running for 5 years, so all 5 years I'll be getting this benefit of 8,000. Fine, which is why what I have already incurred has become immaterial now, right? So this is called as sunk cost, okay, which you have already incurred. So because you have already incurred, it is now immaterial for your decision. Okay. So these costs which have you have incurred in a project, and it will not be recovered now. Okay. If you terminate a project, it will not be recovered. Okay. Now, if you want to replace a plant, okay, so current plant or current machinery, say it's not functioning, then whatever is its book value, it is irrelevant. Okay, because you have to replace it. That is called as sunk cost which you have incurred, and now you cannot include it in your decision. Okay, that is your sunk cost. A normal and abnormal cost you already know, you would be knowing it, right? Normal cost is basically something which is not of an abnormal nature. For example, say if you're going for one type of production, okay, you are manufacturing oil, oil refining, okay, you know that annual cost is, normally the annual cost will be 1 lakh. Okay, this becomes your normal cost. Now suddenly for the same thing, okay, in a year you incurred 1,200 for no reason. Then this 20,000 will be your abnormal cost, because in normal conditions you should have incurred 1 lakh. Okay, so if there is something which cannot be explained, okay, for which you have incurred more amount, that will be treated as abnormal cost. Okay, now avoidable and unavoidable cost, this is something, avoidable is something which management could have avoided it. Okay, you have the chance to take a better decision and avoid it. Unavoidable is something which you have to incur. Okay, if you want to do production, you have to buy raw materials, that is unavoidable. Okay, so unavoidable costs are inescapable, and that has to be incurred for the production which you are going to do. Okay, avoidable is what you can you can do something about it. Fine. Uniform costing. Okay. Now, uniform costing is not a distinct system of costing. So basically, if you have what, say, in one industry, in oil making industry, there is, say, company one. Okay. Okay, you have got these many companies. Okay, oil making company. If all of these agree to follow the same systems of costing, okay, same system. So what will happen is, when same systems of costing, then what will happen is, whenever results will come, okay, there at the end of the year, they can compare it, and if there is any inefficiency, they can find out, correct? If one is using different basis, another is using different basis, you will not be able to compare it. So uniform costing is something when some companies in the same industry, they agree to follow the same system of costing, so that all results are comparable and all of them will get benefit out of it. Okay, that is your uniform costing. And here you can see inter-firm comparison. Okay, so when you follow uniform costing like this, then you will be able to do inter-firm comparison between the firms. Comparison will be possible. Okay. Now, one more thing is engineered cost. So this is something where, when two costs have got some direct relation between each other, such that if you use this much material, you will need this much labor. Like that, you have some cost relationship directly, that is called as engineered cost. Okay. For example, there is a definite relation between raw material and labor. Okay. And based on how much raw material and labor you are putting, you will know how much manufacturing overhead is required and how much products will be produced. These are called as engineered cost, where there is some technical relation. Okay, that's why the word engineered cost. Okay, so there is some technical relation between the two, and you can easily find the input output relationship. Okay, so variable costs are not said to be engineered cost, but some administration and selling expenses are engineered cost. Okay, certain administration and selling expenses, for which product, okay, which kind of inspection is required and all that. So they are called as engineered cost. This is not very important, but you should know just in case asked. Okay, right? So as such, engineered cost, this word is not directly used in any costing parameter as such. Okay, it's just a definition for you. So anything which has got any direct relation, that will be engineered cost. Okay. The next is out of pocket cost. Anything which you have to spend from your pocket is out of pocket cost. Anything which you have to spend from your pocket. This becomes relevant when during times of recession and all. Okay, so because at that point of time, you don't have cash to spend. You might have certain resources, so you are okay to use it, but you don't have cash to spend. That time, out of pocket cost becomes relevant. Okay, so during times of recession and all, say for example, you have a house. Okay, you have a factory. Okay, spare factory you have got. You need something, you need to buy something. You don't have money because it's recession. You are giving this factory on rent to that person. Okay, and in return, he's supplying you some raw materials. Okay, so during times of recession, this will be helpful. Okay, because you will not have money to spend. Okay, that is the only relevance of out of pocket cost. Sometimes you have to think about whether you have to spend it or not. You don't want to spend money in certain cases. Okay, right. So next is managed cost, managed, programmed, or discretionary cost. It is the opposite of engineered cost. Okay, here there is no relationship between the two things. For example, advertisement. You will have do this much of advertisement, but you are not sure how much result it will give to you. So these are called as managed, programmed, or discretionary cost. Okay. And then is your common cost. Okay. So common cost is used in mostly in process costing. Okay. So here what happens is in common cost, there'll be one cost center which will have the which will bear the cost, one cost center. Okay. And that will then be apportioned to some other cost centers. So that will be treated as common cost. Common cost is cost which is there for more than one cost center or cost object. Okay. Example of this is combined purchase cost of several materials in one consignment. You have purchased it together in one consignment. Okay. So it's a common cost for some cost centers. Okay. It's a common cost. Then controllable and non-controllable cost. Okay. If you can control, if managers can control a cost, that is controllable cost. Okay. But if you cannot control it by managerial supervision, okay, then that is a non-controllable cost. Okay. So this is it. Then next nature of classification is nature of production or process. This is nothing but your, okay, this is your methods of costing. Nature of production or nature of process means methods of costing. So all these batch cost, process cost, operating, contract, joint operation will be studying in detail in your methods of costing, which is a 30 marks part for you. So which is why we will not talk about this at this stage. Okay. Yeah, the last one, which is operation cost. Okay. Operation cost basically is something, there are some very complex operations. Okay. There are some complex operations where you have to follow, say, one method of cost, two, three methods of costing for that. Okay. Process costing first. Okay. And then job costing. Okay. Or the other way around, job costing first and then process costing. For example, you are manufacturing different types of vehicles. Okay. And each has to go through job costing. Okay. They're using the 5 different uh, types jobs you are manufacturing. But now you have to paint all of it. Quality of paint is the same. So you can automate a process such that all these will go through the same process and get painted. Right. So this painting will be determined as per process costing and this as per job costing. So when two different methods are used, it is called as operation costing. Okay. Be very alert about operating costing and operation cost. Okay. So or costing. So both are different. Operating is service costing. Okay. So this we will be studying in detail. Operation is combination of any of these. Okay. Right. Cost of specific operation involved in a production process or business activity. Okay. The cost unit is the operation instead of process. Right. Where manufacturing method consists of number of distinct operations. This is suitable. Fine. So operation is just, it's a combination basically where you have to use more than one costing methods. Okay. Now, last is classification by time. Okay. Last is classification by time. So cost item can be is related to a specific period of time. So different things are related to different periods of time. Some are not related to period of time. So when it is related to period of time, okay, what is not related to period of time? Say for example, your materials and manufactured products, it is not related to period of time. Okay. So now what are the costs which are related to period of time? Okay, one is called as historical cost and second is predetermined cost. Okay, so historical cost is backwards in time, which you have already incurred. It is backwards in time. Predetermined cost is forward in time. Okay, it's a future cost. You are calculating future cost. So predetermined cost is of two types, standard and estimated cost. So we will see that historical cost basically is what? Okay, okay, which you have okay, historical cost are actual costs of acquiring assets. Okay, they are post-mortem costs and they are cost of actual performance, so which you have already incurred. That is historical cost. So because it is backwards in time, which is why it is there in classification as per time. Now predetermined cost, okay, are computed in advance of production process. You prepare this cost before production process. Okay, it can either be standard cost or estimated cost. Standard cost are scientifically determined. Okay, okay, it's a basis of cost control and a measure of productive efficiency. Okay, it helps you control costs. Okay, it serves as a yardstick, but you prepare it for future. Correct, you prepare a standard for the future, so it's a future cost. It is used to compare actual cost with the standard cost to determine variances, okay, and to control them. So this is one part of what is predetermined cost, okay, which is standard cost. Second is estimated cost. So standard cost is scientifically predetermined. Okay, scientifically you find out what the cost should be. Estimated cost is also for the future, but just an estimate. Okay, this is also for the future. Estimated cost is found with specific reference to product in question and the activity levels of the plant. It has no link with actual, okay, and assumed to be less accurate than standard cost. Okay, because sometimes see, not every time you will have the time to scientifically predetermine. Many times you will have to estimate some costs. Okay, because you will, for example, for payment and all. Okay, if you predetermine it, only you can have that much liquidity with you. Okay, so you will have to estimate it also. But is it fully scientific? No. At that point of time, whatever data you have, we are just using it and estimating. Correct? So that is called as estimated. So standard costing is scientific. Estimated costing is not scientific, but it has to be used at times. Okay. Then fine. Next is called as techniques of costing. As earlier we saw methods of costing. That's the 30 marks part. Okay. Then you have this techniques of costing, which is also a 30 marks part. And we're going to start this, the next chapter with the next class, marginal costing. Okay. Marginal costing. So what are the techniques? Marginal costing, standard costing, budgetary control. All three are there in your course. Okay. Uniform costing is nothing. Okay. It is just when I just told you some time back that when all companies in an industry, they follow the same methods of costing. Okay. So now marginal cost is variable cost. So we are going to deal with it in more detail. Okay. In your next class, because this is the chapter we are going to do. Okay. In short, okay, in marginal costing, what you do is you find out the marginal cost. Okay. And when the volume is changed, sales becomes more or less, what is the effect on profit that you find out? It's called as cost volume profit relationship. Main thing here is you differentiate fixed cost and variable cost. Okay. So main thing is here fixed cost and variable cost. Okay, you have to divide it and see. So anyway, we'll do it in the next class, right? So some synonyms of marginal costing, very important, will come in your objective questions. Direct costing, contributory costing, variable costing, comparative costing, differential costing, okay, incremental costing, right? All these are this. In this direct costing, you will understand that's marginal. Contributory, because of the word contribution which is there in marginal, you will understand. Variable costing also you will understand. Okay, what you might not get, that you have to specifically remember. Comparative costing, differential costing, incremental costing. Okay, these three things you should remember, right? So direct cost and direct costing is different. Okay, so direct cost is basically your prime cost is called as direct cost in absorption costing. Okay, so prime cost is direct cost, whereas direct costing is marginal costing. Okay, okay, direct cost refers to a cost which is attributable to a cost center or cost unit. Okay, so direct cost means whatever you can identify with a specific cost center or cost unit. All of your material, labor, and expenses, which are items of prime cost, are your direct cost. Okay, so direct costing is a method of costing, is a technique of costing basically. That's why it is different. Fine. Okay, so in direct costing, factory variable overhead is a direct cost. Okay, in marginal costing, variable overhead is direct cost, that we will learn. In absorption costing, it is indirect cost. Okay, absorption costing is just like your P&L account. Anything which comes in P&L is treated as an indirect cost. Okay, now again, next is standard costing. We will not talk about standard costing at this point, right? Fine, because you have a complete full chapter dedicated to this. Similarly, budgetary control, again, full chapter dedicated to it. Okay, so which is why we are not talking at this point of time. Uniform costing we have already discussed. Okay, say use of same costing principles by different organization under the same management. Okay, or on a common understanding between members of an association, or a common understanding. So basically, in one industry, if it is represented by an association, everyone say we will use the same costing method. Okay, so it's not a separate technique or method. It just denotes a situation where everyone is using the same costing method for maximum comparability. Okay, fine. So that is about uniform costing. Now, interfirm comparison is, by uniform costing, you have made all costing uniform. Now you can do interfirm comparison on same basis. Okay, so uniform costing and interfirm comparison always go hand in hand. Okay, if you want to do interfirm comparison, you should always go for uniform costing. Okay, if you are following uniform costing, okay, then you will go for interfirm comparison. Okay, that's why you are going for uniform costing. Fine. So it denotes techniques of evaluating performance, efficiencies, deficiencies, cost, profits of various firms of the same industry. Okay, voluntary exchange of information is done. Okay, so that is it. So now the last part, let's say we will need another 5 minutes and the chapter will be completed. One moment, I'll just okay, so I have to just switch on my battery. Okay, now role of cost accountants in organizations. Okay, this is one separate question which can be asked, which has been asked also. Okay, which is role of cost accountants in organizations. Okay, so again, this thing you have to write in a general way, right? All organizations need a variety of cost information nowadays. Okay, one thing is nowadays, because we have got different types of organizations, they need cost information. Cost accountants collect, assimilate, collate, analyze all financial information relating to organizations. Okay, just write what you do in costing. They consider all material, labor, overheads in order to plan and execute effective management information and control system. Okay. Incorporating mathematical models, investment analysis, internal audit, cost audit, project management, whatever you remember, just write that. Okay. You can always remember internal audit, cost audit, project management. Okay. Whatever remember, write those things. So all these things they do. What role of cost accountants? What do they do? Okay. So they basically analyze cost information, help in decision making. Okay. They collect all information about material, labor, overheads, all that. Okay. And then present it in a format which is easy for management to decide. Okay. They perform one of the most important roles, deal with various reports. So preparation of reports is one function for senior management. Okay. So companies provide greater emphasis on the role of cost accountants. Okay. So role can be enumerated as follows. Now in points, okay, to analyze various elements of cost of production services such as material, labor, expenses, introduce appropriate costing methods in the organization. Okay, so that it will aid decision making. And then, okay, to determine the cost of new product service for pricing decisions. Okay, to take pricing decisions, find out the cost of product. Okay, that's their role. Determine the feasibility and profitability of various project proposals. Okay, variance analysis. And last, collection of extraneous information means outside information. Extraneous means outside. Okay, outside information for management to compare companies' information with that of other companies. Okay, so these are the your role of cost accountants. Okay, this is the role of cost accountant in organizations. Very simply, or for all these things, you should study main point, just study it and then write it on your own. If you just get the habit of that, okay, then it will be very useful. That is it. So we here ends our chapter. Okay, and any question you have, you can ask me. Any questions? You can ask me now also, you can ask me later also, that's not a problem. Okay. So that's it. Okay. So we will meet with the next chapter. Okay. Fine. Thank you.